Hey guys, Young here. So today I'd like to do this quick video recording because I realized a lot of people are practicing this option strategy, which I do not actually like it, and I feel that it's very risky, very dangerous. It's kind of like almost like gambling. So that's why I'm actually sharing with you guys about it. So this is a very important lesson on buying options. Okay, purely on buying options. So what I'm talking about is you're buying calls or you're buying puts, right? So when we buy call, it's like equivalent to us owning 100 shares and going into the direction. For example, if we buy call, we'll be going bullish direction. If we buy put, we'll be going bearish direction. So I realized that, okay, let me just quickly bring you guys over to this Think or Swim platform. So for example, if you're looking at Alibaba, right, we are all taught and trained that when we buy call, we have to buy it very far out in the future. And let me explain to you guys the rationale on it. All right. So first and foremost, if you were to buy call on like 15 January, which 2021, which is like 559 days out. Let me just quickly open it. We have to buy call, probably at 160. You'll spend approximately 3.8k. Let's round it up to 3.8. You actually spend approximately 3.8k, and this is pretty expensive, right? Considering if your account only at $5,000, 3.8k is equivalent to almost 4k. That's almost 80% of your own entire portfolio in just one single stock. So a lot of people, I notice a lot of you guys like to do is they like to go very far near into the future. And then if you were to go the same 170 strike, buying call will only cost you $775, which is significantly cheaper. It's really more affordable for you guys, but this is the wrong thing to do. Let me guys show you quickly why. Okay, so first and foremost, let me just jump over here. So this is the time decay graph. So do you know that the options actually have a time decay? That's why you see this number of days over here, 613. This means how many days to expiry. And then if you're actually selling put, right, every single day that these options premium expires, it's where you decay, it's where you earn money. So for example, like if you were to sell put at 490 over here, then after that when it comes back down to 6 days, 34 days, imagine 34 days ago you sell put, you collect $490. Then at 6 days late, at 12 July, which is 6 days from now, right, your options, the premium will expire all the way. Now it's like $171. So technically this difference is how much you have earned and how much you have earned because of time decay over 28 days. All right, over 28 days, because 34 minus 6 is 28. All right, so this is purely on time decay because we're talking about the same strike price, 172.5, 172.5, and purely on time decay. So if you are to be buying call, okay, if stock price stay the same, similarly if stock price stay the same, you bought it at 635, you spent 635, right? And then right now, even if stock price did not move, meaning stock price either go up or come down, but end of the day it still come back the same strike price, you would have lost almost $400 on itself based on time decay. And this is the reason why, because every single day your premiums are getting lower and lower. If you are buying off call, you will be losing out a lot of money. Now another thing I like to share with you guys is on this thing where you can go to your Think or Swim platform, your what's that, trade workstation, for IB, your Saxo Trader, everything, they all have this thing in for you already. All you just need to do is just go over here and press the delta, gamma, theta, and vega. So for time decay, it will be theta. So you can see down here, right, let me just go out far out in the future. So you can see down here, if I go to 18 June 2021, you can see your time decay, your theta, it will decay at 3 cents a day. All right, if it's not 3 cents a day, it means 3 cents a week, somewhere around there, which is also quite significant. Whereas compared to 6 days later, your theta will actually decay at the same strike price. Let me see what's the strike price for this. 170. Okay, remember 170. At same strike price 170, your premiums will decay at least 12 cents a day, which is equivalent to $12 a day. You're losing $12 a day owning the stock if it goes nowhere at all. All right, so therefore if you buy the stock at a cheap price, you're hoping it go up, but the thing is, stock doesn't go up, you're losing $12 a day. And that's the reason why a lot of people ask me, hey, why I buy call but the stock go up, but then I didn't make money, I still lose money. That's because you're depreciating, your assets are depreciating $12 a day. It's like you buying a car and depreciate every single year, and every single meter you drive, it depreciates. All right, this is exactly what I mean. And I want to bring you guys to this whereby I want you guys to not get affected by all of this stuff. These stuff are like, this is like Robinhood. I actually joined some of these groups to look at what they talk about sometimes lah. So Robinhood, Robinhood is a US brokerage platform, and it charges $0 in commission. And that's the reason why a lot of people buy, like you can see them posting stuff like they buy like 50, 60, 100 option contract on one single stock, and they buy it, for example, like down here, like to buy, let me just, like to buy like 6 days out, then they buy it down here, so you can buy like 100, and it only cost them maybe $900 or $90 around there, so it's a very, very little impact to their portfolio. And the reason is because they are $0 in commission. Now, if you do the same trick as them, you will ultimately lose out a lot. If you, for example, you buy 100 call or put contract. For example, you buy 100 call contract. For example, I buy it over here 100 call contract. Okay, you will just lose straight up $100 in commission at least. So for me, I'm using VVIP rate, so I'm getting $1 per trade. But if for you guys, it will be $1.25, or some of you guys will be like $2.50. So that will be significantly a lot of commission, a lot of money gone to waste because of commission. All right, so in that case, it's very, how do I put it, it's just you're losing a lot of money. And don't follow all these people because they have $0 commission. And to be honest, most of the people that talk inside this kind of group knows nothing about stock market. All they're doing is just betting on single stock. They do not do fundamental analysis, they do not financial analysis. And you guys actually learn already how to do financial and fundamental analysis. So don't listen to them. You can just look at their stocks and everything, you know, all these forums, you can just look at it and then you know, study your stocks yourself, but don't buy into it. Anyway, they also always look at penny stock. I will also advise you guys to not look at penny stocks, because let's take for example like Fiverr IPO at I think $20 over. So FV, okay, how about work? Okay, Upwork Academy, Slack. So Slack straight immediately IPO down here $38. All right, so even a new company can you know, IPO such a high price. So why would a stock stay below $10? Now it doesn't make sense, right? Unless there's no value to the company, and that's why it's at so low price. All right. So anyway, I'm going to end on this quick lesson on, once again, let me bring it back again, very important lessons on buying options. I hope you guys do not fall into the trick that buying a short dated option is actually better than buying a long dated option, because it's not the money that matters, it's how much you're getting how much is depreciating every single day that matters. All right, so once again, thank you very much for tuning in, and see you next time. Bye bye.